Today's sponsor is Datadog, a real-time monitoring platform that unifies metrics, logs, and distributed traces from your cloud containers and orchestration software. Datadog's container-centric monitoring features allow you to track the health and performance of your dynamic container environment. The Container Map provides a bird's-eye view of your container fleet, and the Live Container View searches, groups, and filters your containers with any criteria, like tags, pods, or workspaces. To start monitoring your container clusters, sign up for a free trial today, and Datadog will send you a free t-shirt. Visit datadog.com/container-cloudcast to get started. That's datadog.com/container-cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Another Sunday Perspective show as we continue to move through December 2022, getting very close to the end of the year, last couple of weeks of the year. Hope everybody's doing well and hope everybody's starting to wrap up so they can spend some time with family and around the holiday season. So what I want to cover this week is something that came out about a month ago. And one of the things that if you've listened to the show for a while, you've heard us say this a lot. While it's always important to, follow the technologies and keep up with the technologies that are happening in our industry, it is equally as important and sometimes more important to be able to follow the money, understand, how money is flowing into the industry, where the people that invest in the industry are putting their money, what their perspective is on things, both short-term and long-term. And, so oftentimes, well, we get hung up a lot with, hey, this company raised a round of funding or this company acquired somebody. It's also sort of good to look at the way the venture capitalists are looking at the market, what they're putting out from a public perspective, see how well it aligns with what you see in the market. And so one that came out this year that we kind of follow is a company called Battery Ventures, one of the well-known VC firms out of Silicon Valley. They put out their State of OpenCloud 2022. So really kind of cloud computing and open source, kind of a blending of the two of those things, and looking at both the macroeconomic of the market as well as a lot of the companies that fall within that domain, which, is pretty much kind of where we are as an industry or where the show is as a podcast. And so what I thought I would do is both kind of look at what's in their report. It's about a month old and, they published it right before a lot of the really big companies started doing some layoffs. So, there may be some things in there that maybe they may want back a little bit. But, in general, as I dig through it, and I think about it as, what do they see in terms of the market right now, but also, what are the things that they see in the market or they're talking about in the market could be relevant in 2023. So almost somewhat of a, prediction, kind of a looking forward type of thing. So I thought I would do that. As today's Sunday Perspective, and we'll do that right after the break.
It's our mission to give IT pros a break. So here it is. We wish it was longer, but to keep saving IT pros time and money, we only paid for a 30-second ad. From racks and PDUs to backup power, Eaton and Trip Light have joined forces to bring more sanity to your day every day. Visit eaton.com/audio today.
Today's show is sponsored by CloudZero. For software-driven companies focused on growing margins, CloudZero is the only cloud cost intelligence platform that puts engineering in control by connecting technical decisions to business results. By analyzing cloud services like AWS and Snowflake, CloudZero provides real-time cost insights that help you maximize margins. Engineering teams can answer critical questions like, who are my most expensive customers? How much does this specific feature cost our business? What's the cost impact of re-architecting this application? With cost anomaly alerts via Slack, product-specific data views, and granular engineering context that makes it easy to investigate any cost, CloudZero is your complete cloud cost intelligence platform, connecting the dots between high-level trends and individual line items. Join companies like Drift, Rapid7, and SeatGeek by visiting cloudzero.com/cloudcast to get started today. That's cloudzero.com. And we're back. Podcast. And first thing, I want to thank everybody for being patient with the bad audio quality that we had last Wednesday show. I know I mentioned it. Had a couple people reach out and sort of go like, "Hey, what was going on?" Apologize for that. I just did not bring my good microphone. I was on the road this week and recorded with a set of just sort of the standard sort of Apple headset microphone. So apologize for that quality. Hopefully this week and going forward will be much better. So as we look at this report, and the link to it is in the show notes, there's a couple of real basic things that you're always looking for, right? You're looking for, do VCs who obviously, have a big stake in these companies as much as the owners and the employees and customers and so forth, what's their general tone? That's sort of the first thing we always look for in this. And I think for the most part, at least from a battery ventures perspective, they're still fairly bullish, right? I think everybody is kind of, coming to the rationalization that the last 2 or 3 years, while they've been incredibly difficult on people, also created a pretty amazing, well, maybe not amazing is the right word, but a pretty large sort of bubble for the tech industry. And so while you see a lot of countries and economists talking about inflation from a consumer perspective that, maybe high single digits to double digits in different places around the world, the inflation that basically was happening, value inflation, at least on paper, for the tech industry was enormous. I mean, 20, 30, 40x, maybe what it normally is. So, a lot of them are really trying to rationalize, what's been happening over the last year, basically. And a lot of it boils down to, in the simplest sense of things, really two things. Number one, companies are really kind of coming back to pre-COVID levels in terms of where they are, just in terms of valuations. And so there's some interesting charts within the report. And the second thing is, there's this sort of realization that the last 2 or 3 years, between really low interest rates and the massive amounts of money that government agencies and entities pumped into the economy, drove, crazy valuations. And those valuations are all sort of, again, coming back to really kind of pre-COVID levels. And even to a certain extent, kind of pre-COVID levels for things like hiring and sort of number of people that are within the industry. So, it's one of these things where you look at it and you go, yes, it feels like things are tougher these days, and there's a lot of charts that look like they're sort of going down and to the right instead of going up and to the right. But really, we're kind of getting back to the health of what 2018 and 2019 looked like, as opposed to 2020 through 2022, really. So it's less of sort of a cratering that we saw in previous iterations, but at the same time, again, people are now going, okay, well, this is the new normal. This is sort of where we're kind of getting back to, sort of stabilizing around that. The second thing that you really see is, you're going to hear a lot of talk about kind of good growth versus growth, or, how do you grow companies? How do you grow revenue? And what does that look like? And, I think we had very much a, kind of grow at all costs, because the cost of growth was so incredibly cheap. And, there was a huge kind of winner take all mentality that happened, just pre-pandemic, but throughout the pandemic. You saw a lot of companies who had made investments in certain things were able to take advantage of those, but in a lot of cases, kind of overplayed their hand to a certain extent, that what was happening during the pandemic was going to happen forever, right? It was going to become the new normal. And so I think we're seeing a lot of, kind of rationalization. Unfortunately, that usually ends up being, with some layoffs and with some hard times, but sort of rationalization to get back to good growth, right? Like growing with good solid products, making deals with customers that are beneficial to both of them, not giving away the farm, not getting into, sort of buying the market at all costs, those sort of things. So we're going to see a lot of that. And, the other thing we're seeing is sort of the valuation of companies, or what are sometimes called software multiples. So, what is the value of your company from a stock equity perspective versus, the amount of revenue that you're generating. So let's say your company's generating $10 million of revenue, but your valuation is 50 times that revenue. Those were some of the crazy numbers we saw during the pandemic, and we often see during, boom times. We're really seeing it back to like 10x and below levels. And those really are kind of conservative numbers. I mean, in most healthy times, you see software numbers being, 20, 25x, so they'll call it 20x. We're now seeing it sort of down even below 10x multiples. And so what that sort of says is, we're going to expect to see, investors and are going to expect to see sort of more good growth. Growth is sustainable, growth that they can see and be predictable quarter over quarter. But the other part of it that we're going to see is it's really, having brought down the quote unquote valuation. And again, this is where you see a lot of companies that are, touted as unicorns and decacorns and all these sort of things. Their valuations are going to get kind of reevaluated to a certain extent, depending on if they're taking on new funding and so forth. But you're going to potentially see, some companies who you would never thought would have gotten acquired because their valuation was way high and those seem sort of out of control. Maybe become acquisition targets in 2023 or even early 2024 as either they, burn through their cash and they're not able to raise funding at another level that's acceptable to everybody in the market, or, some of the larger companies look at them and go, they're really a good value at this point and they can be, valuable in building their portfolio. So I think we're going to see some of that. We may see a, kind of a boom in acquisitions that we haven't seen necessarily a whole lot over the last couple of years because valuations have gotten so crazy. Now, the other thing that is kind of in this report, lots of companies, as we've seen over the last couple of months, we've, talked about it a little bit in Cloud News of the Week, a lot of companies evaluating their hiring levels, their worker levels, and to a certain extent, their buying levels, their cost levels. So, this is normal. Again, getting back to, kind of the getting away from the craziness that we've had the last 2 or 3 years, getting back to something that's sustainable, that fits the business, that fits the core of their business, what they can do repeatably and differentiate themselves over and over again versus kind of a lot of these, moonshot kind of projects that got hired, that got funded and hired and so forth. So we're going to see a lot of normalization through that. I mentioned, we may see some acquisitions. The other thing that you can't keep in mind though is, while we've seen a lot of headlines about job cuts, a lot of them have been more headlines of like this company and this company and this company and this company. And you sort of go, oh, wow, it seems like all these companies are cutting jobs and maybe the sky is falling. But the reality is most of the cuts, aside from a few, right? So maybe something like Twitter gets a lot of headlines, but most of them have been a pretty reasonable number. And I don't like to use reasonable as a number with job cuts because we're talking about individuals and people and their jobs and families. But when the numbers are like 10% or below, those numbers aren't really unreasonable, especially given the amount of ramp up that happened over the last 3 or 4 years. So, if you go back a decade or 15 years and you talk to any sort of business school professor or anybody who's kind of been around sustainable businesses, they'd say, look, you probably have 5, 6, let's say 5% every year that you could create an attrition situation for, just because those people aren't, they're not cutting it. They're not getting enough work done for you or the quality of work that you want done. So, be cautious when you see a lot of companies, names in the paper for headlines of, so-and-so cut jobs, and really sort of look at the number of jobs. Because I think what we've seen at this point is not unreasonable numbers for a correction. It's again, they've been more single digit numbers, except for a few unique cases than some things. And again, we never want to see people out of work. And I know Aaron talked about it in Cloud News of the Week a couple weeks ago. Somebody had put together a really good spreadsheet that includes jobs that are hiring. So, the market is not sort of, cratering out. We're just sort of seeing movement to rationalize what's best for certain businesses and best for certain skills and things like that. As I kind of go through more of what's in the report, a couple other things jump out at me. I think we're seeing more and more data that's telling us that, while there's a lot of really great software companies out there, the ones that are software companies but are also offering cloud services. So we've talked about Mongo and Confluent and Elastic and, Red Hat and VMware and a lot of others are beginning to do this. We're seeing for the ones that have been in this business for 3, 4, 5 years, we're now beginning to see the growth rates of those, on bigger installed bases, not just like early days, but like multiple years into it. Those growth rates are now 3, 4, 5x what the software business is. And sometimes the software business is still bigger, but we're starting to see that become really accretive for the business. And so I think we'll continue to see software businesses starting to say, hey, I at least have to have some sort of cloud offering for what I do, not just be in a marketplace, but be in cloud offerings, because the data is beginning to back up that, it's a really strong way to grow the business. And obviously it aligns very well with the part of IT spend that wants to be in the cloud, wants to be on demand, wants to be, delivered as a service and so forth. I think we'll continue to see that as a growing trend. A couple other things that I thought were interesting, and then I'll kind of wrap up. First one was, they mentioned, and this seems very obvious, but, we're seeing cloud providers, the big three cloud providers, plus, a couple, 3, 4 others, continue to grow. They're still growing at multi-billion-dollar rates. We're seeing, 20, 30, 40% growth still on, tens and tens of billions of dollars of growth. So, I know there was probably a lot of question about, can they continue to grow at the rate they are? And as of right now, they are. Right now, what'll be interesting is, a lot of these were able to make investments, the billion-dollar, multi-billion-dollar per quarter when interest rates were lower, and as they become bigger and bigger parts of Microsoft's business, it's now 50% of Microsoft's business, is in the cloud. It's it's a huge revenue driver for AWS, maybe a little less for Google. Are they still able to continue to make these huge CapEx investments, or are the CapEx investments also blended with the bigger company? So still an open-ended question, but we have seen and even continue to see, even in the last couple of years of economic kind of up and downs, those companies are continuing to grow, continue to begin to be more profitable. So expect to see that business continue to be very, very robust. And then the last piece is, I think we always have to come back to historically. Like, we talk a lot about innovation, being a driver and digital transformation, but productivity is always something that businesses are looking at, and even when times get tough, we've seen some people get laid off. Again, unfortunate. Software and technology typically kind of fill that gap, especially as businesses are looking to be more productive. So, software has a nice, software is not immune from, economic downturns or even inflation or whatever. But software and technology do tend to be able to both fill the gap for driving innovation, but also driving productivity. And so I think, we'll continue to see, pretty healthy growth, of those projects. They will get scrutinized a little more. They will be looking for return or, impact on a shorter basis than maybe they were before. So, for those of you that are in the selling business, make sure you have your story straight and you're able to talk about, how to get to value, technical value or business value very quickly. And then the last thing, if you're reading the report, I think it's a good report to read. The second half of the report is really interesting. So the first half of the report is very much sort of a state of the market. The second half of the report is very interesting if you are either a business, you're on the selling side of things, you're a vendor, but you're maybe looking at your partners, you're looking at the vendors that you buy from. They really do a good job of breaking down not just, what technologies are winning, but what's the winning go-to-market formula? What's the winning organizational formula for companies? It's no longer just, we make a product, we sell a product, we hope to have a long-term contract. There's a really broad spectrum from, SaaS offerings, product-led growth, kind of a blend of software and SaaS. How do you go to market? How much of it's free trials? How much of it's, tiered kind of pricing and so forth? And so if you're into, not just is the technology interesting, does it solve a technology problem, but, how are the winning companies, the companies that are growing the best, the ones that are showing sustainability, how are they organized for success? And what are the trends in how that works, which obviously is something that the VCs play a big role in terms of, trying to bring their knowledge to and try and do repeatably. The second half of the report, if you skip the first half of it because you go, well, it's just predictions. The second half is really interesting. And I think, it's something that, as you're evaluating your vendors and, depending on what your role is in this industry, something to definitely take a look at and look at, are we aligned to the things that seem to be best practices? Are we aligned to the things that seem to be fairly legacy? And kind of get a sense of how far are you from good versus how close are you to, struggling, those types of things. So I would definitely, if anything, recommend the second half of the report. It's something that if you're not in the industry and you're not, you're not on the selling side of the industry, it may not seem as critical for you to review. But I think as you're thinking about the vendors you're working with, it is always important to not only understand, do they make interesting technology, but are they doing the things that is going to help them sustain the business. Because, as you're looking at your vendor relationships, the risk that a vendor brings to you or doesn't bring to you, I think those are just as important. So it's, kind of goes back to the old adage of it's important to follow the technology, but it's also important to follow the money. And I think the second half of the report does a really nice job of that. So anyways, with that, I'm going to kind of wrap it up. Not a real long Sunday perspective, but I thought this was a very interesting report in terms of, where are we in the industry for the people that are putting money into the industry, essentially making bets on this. And where does the money look like it's going? Where does it look like it's going faster? Where does it look like it's slowing down? Where does it look healthy? Where does it look unhealthy? And so, it's good for us to, especially this time of year as we're moving into the next year, people are working on budgets, they're making forecasts, they're making predictions, to have some ability to come back and anchor it in something. So with that, I'll kind of wrap it up. Thank you all for listening. We are getting very close to the end of the year. I think we've got about 5 or 6 shows left for the year. A couple of really fun ones, typically ones we do every year, year-end wrap-up predictions. Couple of good guest interviews left for the year. So don't go away. We will have lots for you to listen to if you're wanting to get away from your family for the holidays, or you just, you're going to be traveling or whatever. We'll have plenty for you both Wednesdays and Sundays. So with that, I'll wrap it up and we'll talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.